Alright, you're welcome to today's class of Great Mastermind Builder Solution Center. We are going to be offering financial accounts. Meanwhile, I will introduce the professor that will be taking you on this financial account. It's a professor, it's a doctor in accounting, Professor Samson. You're welcome, sir. Welcome, sir. Thank you.
Alright, good day everyone. This class we are going to be looking at financial accounting, which is topic is introduction to accounting. Introduction to accounting ratios. So, some students find it difficult why studying or dealing with accounting ratios. And what is the essence of these accounting ratios? So let's look at the meaning of accounting ratios. Accounting ratios are tools that are used to analyze and measure the performance of a business organization. They are tools that are used to analyze and measure the performance of a business organization. What am I saying in essence is that to know if the performance of the organization, if they are making a profit or if the rate of the stock of turnover is making an advantage to the company. So what are those tools? What are those tools that are used in terms of analyzing or in terms of measuring the performance of every organization? And we know that in every organization, the main purpose is to make profits. So you need to measure this. And what are those things are used to measure this? Is one of these is accounting, which is lead us to what we call the accounting ratios. The tools that are used to analyze and measure the performance of business organization. So what are those tools? These are the tools. The first one we have the markup. We have the markup under the accounting ratios. That is to measure the rates, to measure the performance, to analyze. We have margin. Then thirdly, we have the managers commission. Then we also have to look at the net profit percentage. The net profit percentage of sales. Then we need to look at the gross profit. The gross profit percentage of sales. Then we also have the stock turnover. The stock turnover. Now, these are the tools, the accounting tools, accounting ratio tools that are used to analyze, to measure the performance of a business organization. And what are those tools? These are the tools. The first one we have is the markup. The second one we have is the margin. The third one we have is the manager's commission. The fourth one we have the net profit percentage of sales. Then the next one we have the gross profit percentage of sales. Then we have the stock turnover. So we're going to look at these one after the other. Now, look at markup. We are taking the first one, which is the what? The markup. What do you mean by, what do you understand by the markup? The markup shows the relationship between the profit and that of the cost price. It shows the relationship between the what? The profit and the cost price. That is markup. Markup. That is the markup. Then what about the margin? Margin shows the relationship between the profit and that of the sales price. You are looking at your profit and your selling price, while markup is looking at the profit and that of the cost price. Now, looking at the manager's commission now, the manager's commission is about looking at the profits, showing the relationship between the profit before tax, before commission, and before or after what commission. It says that manager's commission says that it shows the relationship between the profit made before the commission and after the commission being paid to the manager. What am I saying? This is that in every organization there is a commission based on the numbers of sales you make. Now, if you are to make a commission, that means you are giving a commission to the manager based on what he did, based on his performance. You are trying to look at the relationship on his performance during a particular period and previous year. That means you are looking at the basic commission, that is what is his performance, because the more sales you make, the more commission you receive. Now, the more you pay, the more you sell, the more commission you receive. Now, you are trying to look at the relationship of the commission received by the manager for this particular year and the other and the previous year. Now, that's what we are looking under the manager's commission. Then we look at the net profit percentage. The net profit percentage is trying to show the relationship of the net profit between that of the sales. Then why the gross profit percentage is to show the gross profit, the relationship of the gross profit between that of the sales. Now, what do we mean by the stock turnover? The stock turnover means the number of stock, that is the total number of stock that is being made at a particular period of time. That is the stock turnover made, the number of stock made within that period of time. That's what we mean by the stock turnover. And what we mean by the turnover, just like when we have your stock. As a business, you start a business. Now you have some stock inside your warehouse, inside your stock, and that's at the beginning of the period or at the beginning of the year. And you are trying to look at your performance during that year, the one that you used to start the business, and the one that is being remained, that is the closing stock being remained. So you need to look at that, and that of your cost of goods, because you need to know your cost of goods that is being sold compared to your stock in that of your warehouse. Now we are going to look at that is the second one within now, which is just of accounting ratios. Now we are moving to the mathematical formula. That is the mathematical formula, that is the mathematical approach while dealing with all these things. Now there is a formula that's been applied. So we start with the markup. Markup. Now I said markup is to show the relationship between your profit and that of the what? Cost price. Now, how do I calculate my markup? Markup is always your profit divided by your cost price times 100 over 1. That is what we mean by the markup. Markup, profit over the cost price that is shown on the line. That is one of the tools that is used to analyze or to measure the performance of the organization, that is the business organization, basically on profit now, which is markup is one of the tools. The formula is what? Profit over the cost price times 100 over 1. Then now we have which is the next one, which is the margin. Now, looking at the margin now, margin. The next one is margin. Margin. The formula for margin, how do you calculate, how do you measure it? How do you calculate or estimate our margin? The formula for margin is profit over sales price or selling price times 100 over 1. That is margin. Profit over selling price or sales price times 100 over 1. Because we said that margin is to show you the relationship between your profits and your selling price. Then we now want to go, the next one is the manager's commission. The manager's commission. So the manager's commission, the mathematical approach or expression for manager's commission is the profit of the commission over the profit times your profit before commission. Now, manager's commission, the formula is profit of the commission, then profit of commission over 100 plus profit of the commission times profit before commission. That's the formula for the manager's commission. Then we now have the net profit percentage of sales. Now, the net profit percentage of sales There is a formula for that. There is a mathematical expression for that. The mathematical expression for the net profit percentage of sales is, on the net profit percentage, net profit percentage is your net profit over your sales times 100 over 1. That is net profit percentage. That's your net profit divided by sales times 100 over 1. Then how do you calculate our gross profit percentage now? Then our gross profit percentage, is the gross profit percentage is your gross profit over your sales times 100 over 1. This is our gross profit percentage. Gross profit over sales times 100 over 1. That's how to estimate or calculate our gross profit percentage. Why am I giving you all this formula? Because by the time we start solving some questions, we are going to apply all these concepts, all these mathematical formula. Then the least, not the last, where we have the stock turnover. The stock turnover, which I said means the number of times the stock is being turned. The number of times the stock is being turned over within that period of time. That's what we are saying under the stock turnover. So, and then what is the formula for the stock turnover? The formula for stock turnover is we have the cost of goods sold, divided by opening stock plus closing stock. Opening stock plus closing stock, everything divided by 2. What am I saying here? If you look at it now, the numerator there is because of goods sold standing on its own. Then the denominator is opening stock plus closing stock. After adding it, then you now divide it by 2. After that, before you now start dividing your cost of goods sold with what you got here. But by the time you solve question, you understand more better. Now, that is the formula or the mathematical formulas for each of these tools. All these things we are doing is tools. That's tools under accounting ratios to measure the performance of every business organization, which is to analyze your profits, to analyze your stock. That is what you have or what you have available, what you have in your warehouse, your stock turnover. You want to measure the performance of it, and you also need to measure the performance of the managers based on their commissions. That means you want to know if they are doing well or not. Maybe you have different branches, different managers that is managing different branches, and then inside these branches they have to make sales. So then you can compare, like maybe this year they were able to make a sales of millions of sales. Then the following year, that means the commission they will receive for that millions of sales that they made for that year will be different from the numbers of sales they make the following year. Based on the numbers of sales, that is the commission they will now receive from all the sales they have made for that year and the following year. So you need to compare their performance to analyze it. Then we now take an illustration, that is a question of this concept, so that you understand what we are saying now. So let's look at this particular question, which is we have Ade and Sons Enterprise. Ade and Sons Enterprise bought 1,000 units of coke at 2,000 naira each. At 2,000 naira each, and sales at 3,000 naira each. Find the markup. Now, we said that markup, we said the formula for markup is the profit over the cost price times 100 over 1. We are looking at this particular question. The question is, Ade and Sons Enterprise bought 1,000 units of coke at 2,000 naira each and sells at 3,000 naira each. find. A, the markup. B, find the margin. Now, I know that the formula for markup is profit over cost price times 100 over 1. Now, how do we determine our profits? We know that profit is always your selling price minus cost price. Your selling price minus cost price. Now, if you look at this now, our selling price in this question is 3,000 naira. Minus our cost price is 2,000 naira. So that means we have 1,000 naira gain per unit of the product, which is per unit of coke. That means 1,000 naira profit is made per one bottle. That is 1,000 naira profit is made per one bottle. That is per unit. Now we need to know the numbers of, we need to know the total profits on 1,000 units, because they said they bought 1,000 units, and out of 1,000 units, that means each of the coke, that is per unit of the product, is 1,000 naira profit or 1,000 naira gain. So we need to know the total amount of profits made. So how do we do that? So the total amount of profit made, the total profit for 1,000 units, that's 1,000, that is 1,000 naira times 1,000 units. So there we have, that is 1 million. So the total profit that Ade and Son Enterprise were able to make from this is 1 million. That means after removing your selling price from your cost price, you get 1,000 naira, and total amount of the products, you said, is what? 1,000 units. So 1,000 naira times 1,000 will give me 1 million. So that is the gain, that is the profit in Ade and Sons Enterprise. So now, but the question is, we have defined the markup. We have defined the markup, and we know that the markup is profit over cost price times 100 over 1. Now, our profit is 1 million. Let me do it somewhere. So our profit is 1 million over, then our cost price. What is our cost price? Our cost price is 2,000 naira. But we write 2,000 naira because they said 1 unit is 2,000 naira. So that is 2,000 naira times this 1,000 units. That is our cost price. 2,000 naira times, that is 2,000 times 1,000 units. Then times 100 over 1. So we have 1 million over 2 million times 100 over 1. So if you can calculate this now, we know this and this is gone, is cancelled. This 0 and this 0 is cancelled. So we have 2 here is 1, 2 here is 50. So we have 50%. So we have 50%. 50 what? Percent. So we have 50%. This, that is on markup, 50%. How do I get this 2 million? 2 million is the 2,000 naira times 1,000 naira, because 1 unit is 2,000, then that's 2,000 times 1,000 naira. So there you resolve this particular one, which is the margin. So by that time we will continue from there. So you take this one as an assignment, then you solve that. If you have any question or anything you want to ask, you can go straight down to our YouTube channel there, drop a comment or a question or whatever you do, just put it down there, they will sort it out. Thank you, and God bless you.
Thank you very much. Thank you. We'll be seeing you in our next classes. Bye for now. Great Mastermind Solution Center. Thank you.